If there's one corner of global finance that even seasoned professionals find confusing, it's this one, the reverse repo market. It's where trillions of dollars move every single night, quietly balancing the gears of our financial system. And yet, in 2023 and 2024, something very strange happened. Over $2 trillion flooded into this obscure corner of Wall Street, and for a while, nobody seemed to understand why. Banks, money market funds, and giant corporations were suddenly parking their cash with the Federal Reserve instead of lending it or investing it. Some analysts called it a liquidity trap. Others whispered about a silent crisis brewing beneath the surface. But what was really going on? To understand this $2 trillion mystery, we have to step into the hidden plumbing of the financial world, the world of repos and reverse repos, the invisible pipes that keep global money flowing. And let's start simple. A repo, short for repurchase agreement, is basically a short-term loan, usually overnight. Imagine one party sells a security, like a U.S. Treasury bond, to another party with a promise to buy it back the next day at a slightly higher price. That price difference is effectively the interest on the loan. It's like pawning your government bond for cash, just for a day. Now, a reverse repo is the exact same transaction, just from the other side. When the Federal Reserve does a reverse repo, it's borrowing cash from the financial system and giving out treasuries as collateral. In other words, the Fed soaks up excess cash. Normally, this is just a quiet, technical tool the Fed uses to manage interest rates and keep the money supply in check. But when the amount of money in the Fed's reverse repo facility exploded past $2 trillion, it was a signal that something was clearly off. So, how did we get here? It all started with way too much cash and not enough safe places to put it. After the 2020 pandemic, the U.S. government unleashed an unprecedented wave of stimulus. Trillions of dollars in relief checks, corporate bailouts, and quantitative easing flooded the financial system. The Fed printed money to buy bonds, and the Treasury issued debt to fund the spending. As a result, banks, corporations, and investors suddenly found themselves sitting on mountains of cash. But here's the twist. There weren't enough safe places to park all that money. Yields on short-term Treasury bills fell to near zero. Some even went negative. Banks didn't want more deposits because of strict regulatory costs. And all the while, inflation was eating away at the value of that cash. So where could you park trillions of dollars overnight, safely, and still earn a decent return? The answer was the Federal Reserve's reverse repo facility. It was a special window where money market funds could deposit their cash in exchange for Treasury bonds as collateral. At first, it seemed harmless, just an efficient way to manage all this extra cash. But by 2023, the volume had exploded. Every single night, between $2 and $2.5 trillion just sat there, idle at the Fed. The big question was, why wasn't this money being put to productive use in the real economy? To understand the deeper cause, we have to look at three forces that collided all at once: monetary policy, regulation, and market psychology. First, the Fed had flooded the system with reserves through years of quantitative easing. That created massive excess liquidity. Normally, banks would lend or invest that money, but they didn't. Why not? Because of regulations. After the 2008 crisis, rules like the supplementary leverage ratio limited how much risk banks could take on. They were basically punished for holding too many assets, even super safe ones. So when all this cash poured in, banks just said, no thanks, and pushed those deposits away. The money ended up in money market funds instead. Money market funds, in turn, don't make loans. They need ultra-safe short-term investments. But with Treasury bill issuance shrinking due to government spending patterns and debt ceiling drama, the safest and most liquid option left was, you guessed it, the Fed's reverse repo window. Second, the Fed's own interest rate policy created a strange incentive. When inflation surged in 2022, the Fed started raising rates aggressively. But it also started paying a high interest rate on its reverse repo facility, almost the same as the main federal funds rate. This made parking money at the Fed incredibly attractive compared to lending it out or buying short-term treasuries. So while the Fed was trying to tighten policy and reduce liquidity, it accidentally created a black hole that was sucking it all up. Third, there was psychology, plain old fear. After years of low rates and easy money, investors were spooked by volatility, bank failures like Silicon Valley Bank, and rising recession risks. The safest play became just sitting in cash. And when cash pays you 5% at the Fed with zero risk, why would you bother lending or investing? So this $2 trillion mountain was the result of too much money, too little risk appetite, and regulations that discouraged lending. But this created some serious consequences for the economy. The first impact was on liquidity. When trillions of dollars sit idle at the Fed, they're effectively removed from circulation. This tightens financial conditions, even if the Fed isn't actively shrinking its balance sheet. It's like a hidden form of quantitative tightening. The second impact was on the Treasury markets. The US government relies on a constant flow of buyers to fund its debt. But if trillions are parked at the Fed instead of bidding on treasuries, that demand weakens. The irony is brutal. The same Fed that wants stable markets may have been draining the very liquidity needed to keep them stable. The third impact was on money velocity, the speed at which money moves through the economy. When cash sits motionless, it's not financing new businesses, mortgages, or innovation. It's frozen capital. And frozen capital means slower growth. This is why some analysts started calling it a shadow liquidity trap, a world where trillions of dollars exist but can find a productive home. So the big question is this a crisis or just a strange side effect of modern finance? Some argue it's not a crisis at all. The reverse repo facility is just doing its job, like a sponge soaking up excess liquidity. When the Fed eventually cuts rates or the government issues more treasuries, that cash will naturally flow back into the market. But others see it as a major red flag, a sign that the system is stuck. They warn that if that reverse repo pool suddenly drains too quickly, it could destabilize short-term funding markets, just like it did in September 2019 when repo rates spiked overnight and the Fed had to step in with emergency liquidity. So what could trigger that? A surge in new government debt issuance could do it. As yields rise on new treasuries, investors would pull money from the Fed to buy them. Or if the Fed cuts the rate it pays on reverse repos, that could also send funds flooding back into the market. Either way, the transition has to be smooth, because if $2 trillion suddenly start moving overnight, it could create chaos. Think of the reverse repo market as a massive dam. Behind it sits a giant lake of idle cash, calm for now, but waiting for the floodgates to open. And this connects to the bigger picture, the global dollar system. The US dollar is the world's reserve currency. When the Fed tightens and money gets trapped in reverse repos, dollar liquidity shrinks everywhere. Emerging markets feel the squeeze, global funding costs rise, and risk assets, from stocks to crypto, start to wobble. Let's step back and look at the philosophical irony here. The reverse repo facility was created to give the Fed more control, to fine-tune the financial system like a thermostat. But in trying to control it, the Fed may have exposed just how fragile the system really is. A $2 trillion pile of cash doing nothing isn't a sign of efficiency. It's a sign of imbalance, an economy drowning in liquidity but starving for productive investment. As we move forward, this story is still unfolding. The Fed is shrinking its balance sheet, Treasury issuance is ramping up, and those reverse repo balances are slowly declining. But this whole episode left a mark. It's a reminder that the plumbing of our financial world is more fragile than it looks. The reverse repo mystery may not have been a traditional crash with screaming headlines, but it revealed a deeper truth about modern finance, that you can flood the world with money and still wonder why the system feels starved. And maybe the real crisis isn't in the repo market at all. Maybe it enters in the logic of a system where the ultimate safe asset is a promise from the same central bank that S trying to escape its own trap. Because when $2 trillion sits still, and nobody can quite explain why, that's not stability, that's a warning. Thanks for watching. If you found this deep dive interesting, be sure to hit that like button and subscribe for more content that breaks down the complex world of finance. See you in the next one.